If you're investing in Broadcom for the AI boom and simply reading through the earnings report every couple of months, then you're not getting the whole picture. It's the 10Q filing that has all the juicy details about where growth is coming from, how the business is becoming more concentrated over the last year, and what management is trying to quietly warn you about. In this video, I'll show you where all that good stuff is located in the 10Q report so you get a deeper understanding about the business without having to read every line yourself. We'll start with what Broadcom actually does, then how the business is changing with AI, particularly over the last year, the biggest risks buried in the filing, the key growth and profitability metrics to track, and finally cash flow and what management is doing to use all that cash flow. And then I'll wrap up with some investor takeaways that I think matter most right now. Looking here at the 10Q report now for the period that ended in early February of 2026, we just need to go down to this section 2, item 2, called Management's Discussion and Analysis of Financial Condition and Results of Operations. And we just zoom down here to page 22 for management's description of what the company really does from their own mouth here. We are a global technology leader that designs, develops, and supplies a broad range of semiconductor and semiconductor-based solutions and infrastructure software solutions. So those are the two big things, basically software and chips. But as we're going to see later on in this report, software is not really a big part of the business anymore, or it's becoming a much smaller part of the business as it transitions towards an AI growth company itself. Our solutions are also used in a wide range of environments, management says, including, but they highlight here, enterprise and artificial intelligence data centers, servers and networking and connectivity equipment, as well as storage systems and dozens of other products. But management is going to describe here why really all the growth and all the sales expansion over the last year has come from this artificial intelligence data centers and support for that. We have two reportable segments, management says, semiconductor solutions and infrastructure software. And then they highlight here right at the beginning to sort of give a sign that management is pretty interested in delivering cash to shareholders. They mention right at the beginning with their first metrics that they generated $8.3 billion in cash from operations in this past quarter. And out of that cash, they delivered $3 billion to shareholders in dividends, and then another $8 billion they spent on repurchasing stock. So you can see that, just by looking at that math, they actually spent more on returning cash to shareholders this quarter than they generated in operating cash flow. So let's continue down, and here on page 24, we'll see some metrics here that I think are worth highlighting. Sales grew about 28%, blistering sales growth for the quarter from 15 billion to 19 billion, and we can see that 100% rate, but sales growth really just came from the product segment that expanded from 68% of the business, you can see here, to 73% of the business in just the last year. We can also see that cost of revenue remained the same, 32% overall. So that means that gross profit margin held steady at 68% of sales, which is, I think, fantastic for a manufacturing business like this. They did cut costs in a few little places, and because of that, you could see that operating expenses declined from 26% of sales to 24% of sales in the past year, and that was 3.9 billion a year ago to 4.6 billion, but still as a percentage of sales that shrank. And because of that, our operating profit margin improved from 42% of sales last year to 44% of sales this year. Now let's go on to one big risk that management wanted to highlight here at the bottom of page 24. A relatively small number of customers account for a significant portion of our net revenue, management says. They don't say which customers these are, but we can infer, and we do know that they are big hyperscalers, companies like Alphabet. Direct sales, it says here, to one semiconductor solutions customer in particular, which is a distributor, accounted for 42% and 29% of our net revenue this quarter and then the same quarter last year. So not only is one customer accounting for 42% of sales, a huge amount this year, but it's also way bigger than it was a year before. So 29%, this customer was worth 29% of the business. And now this customer is worth 42% of the entire business here in early 2026. So obviously that creates a big risk for the company. If one of these AI companies, particularly this AI company, sees a drop in demand, then Broadcom is going to see a significant drop in demand by itself. And they mentioned that here. We believe aggregate sales to our top 5 customers through our channels accounted for approximately 50% of our sales, up again from 40%. So we already saw that one customer is worth about 42%, but their top 5 customers are worth half of revenue right now. And then they mention here the loss of or significant decrease in demand from any of our top 5 end customers could have a material effect on our business. And that's maybe sounds like stating the obvious, but it's an important thing for investors to know that the business is highly sensitive to AI spending right now, particularly in the biggest 5 companies in the business. So let's look at another few ways that the business is changing here in the last year. The semiconductor solutions segment here, we can see grew at a 52% rate, but their software division did not grow at all. It was basically flat, 1% higher sales for the quarter. So all the growth is again coming from that semiconductor solutions segment. So we do know that the company is becoming much more concentrated in that way. And you can see here that's put in another way. The semiconductor solution segment was roughly half of the business a year ago, and then the software was worth about 45%. And now we're seeing that figure jump to 65%. So semiconductors are worth about 65% of the business, up from 55% a year ago. And that's just a huge change for any business, particularly something this big. But it just speaks to the scale of the AI growth that Broadcom is benefiting from right now. But it also illustrates how the company is changing in its structure, and it's not really a diverse business anymore. It's getting most of its growth, and most of its sales are now coming from this AI boom. Okay, heading down to the list a little bit more here. We're on page 26 of the 10Q report. Another way to see that the growth has been particularly concentrated in the semiconductor solutions segment. That was up 59%, compared to infrastructure software was 4%. This is in profits, not sales. And management just says that the reason for this change was strong demand for our networking solutions, primarily custom AI accelerators and AI networking products. And then to wrap up the figures, we're going to look at cash flow and capital returns. We can see that Broadcom, if you invest in the stock, you know that it's not a really big dividend paying stock. The yield is less than 1% right now, but they do pay a dividend, and the dividend is growing. It was 59 cents per share a year ago. It's gone up to 65 cents a share now. So instead of $2.8 billion, they spent roughly $3.1 billion this quarter on returns direct to investors in dividends. Operating cash flow was $6 billion a year ago, and then it improved to $8.3 billion. That's fantastic growth, and I think that means that reflects the fact that Broadcom is not having to spend a whole lot of money to invest in this growth, in contrast to a lot of the hyperscalers themselves. Companies like Meta and Alphabet are spending aggressively, but Broadcom is not having to do that to support the extra growth. However, we can see here that the cash used in financing activities was $10 billion. So they generated $8 billion in operating cash flow, but they spent $10 billion in financing activities for a negative cash flow this quarter of $2 billion. But if we look here at the bottom of page 28, we can see why that is. Financing activities was mainly an increase in stock repurchases. So the company, as they mentioned earlier, they do prioritize returning cash to shareholders, and so they spent roughly $8 billion this quarter returning the cash to shareholders through stock buybacks, and then $3 billion through the dividend. And here is a great illustration of those figures. You can see in the red, this is cash from operations, and it's been growing every year, particularly in the last few years, from $19 billion in free cash flow to $27 billion, and then to now $29 billion over the last 12 months. And here at the bottom, we can see spending. Management has decided to spend roughly $12 billion over the last 12 months on stock buybacks and $11 billion on dividends. So what are the big takeaways for investors? Well, clearly this is a fast-growing business, accelerating sales. Sales were up 28% this quarter, and I think the outlook for that looks great. It is a shareholder-friendly business, so they do prioritize returning cash to shareholders, and that's really good news, especially considering the fact that the company does not need to allocate a whole lot of cash toward the business when it's doing this manufacturing boom. It's also becoming slightly more profitable. That's fantastic too, and that says good things, I think, for earnings growth over the next several years. However, the company is very focused and becoming much more focused on AI growth itself and on the AI demand for data centers, and that's changing the composure of the business. It's not so diverse anymore. It doesn't have a lot of sales coming from the software segment. In fact, all the growth is coming from the AI business too. So that's something for investors to really be aware of, that there's a lot of exposure to the AI boom, and if that slows down, then Broadcom's sales will slow down too. But I want to hear from you. What do you think about Broadcom? Do you think this stock is a good buy right now? And how do you like the business as a way to get exposure to the AI boom?